Hey everybody, it is Chuck Barone. Thursday, October the 10th, 2024. Another day of madness, guys. You saw the Federal Reserve got their numbers today. We were waiting. We knew we were going to get CPI. We knew we were going to get jobless. I'm sure you guys have seen these numbers and know that while they weren't terrible, they weren't what we were looking for today. And we're going to talk about it quite a bit on the show, but it kind of might put a little bit of pause into the Fed as far as this super aggressive, if that's what you want to call it, rate cutting cycle. I don't know, man. This is what I've been telling you guys, though. I've been warning about it and talking about it, saying that, the experience of the 70s and 80s, where the Federal Reserve just cut rates too fast, too soon, couldn't wait. They were going to prop up. They said the same exact words. Now it's not less about inflation and more about jobs in the economy. And they cut rates, and then they had to raise rates again because inflation perked right back up. And then they raised rates and beat inflation down, and then they cut rates, and boom, boom, boom. It was a cycle like that. And it finally got Arthur Burns dropped as Fed chair. They put Volcker in. And Volcker smashed that inflation to smithereens by raising rates of 20%. Now, I think that if the Federal Reserve was going to raise rates of 20% today, it would be a total collapse of the economy because we're so debt. What's the right word? Debt. We need debt to function, right? We're debt reliant, I guess, to function. And imagine what that would do to the federal government, not the Federal Reserve, but the federal government's payments on, their massive $35 trillion friggin' debt. So I don't really see that coming around this time, but I think the Fed's going to have to certainly be more cautious, and hopefully they can find a way to make the data go a little better for them in the next couple of reports. But anyway, I'm getting a little ahead of myself. I tend to babble, as you guys know, but let me take a half a second before I get rolling here and welcome everybody to the show. Welcome all my friends on the chat. Nice to see everybody, all my regulars. You got Miggy and Wolf and Smoke and Dave and Molly and, a few Jordan on today. Nice to see you, Jordan, Miggy. We got Andrew Simmons on today, who goes by his middle name, which is, it's in here somewhere. Where the heck did I see it? Anyway, it goes by his middle name, David. Nice to have you, David. We got a big show today. A lot of stuff to talk about. We know these numbers. Well, we'll go in a little bit of depth on what all of it means. Anyway, let's talk about markets. So we got this data. The market did not react well, but it didn't really. Honestly, I thought that the numbers in the stock market today would be a little bit worse than they are. Stocks fall across the board, but not in a big way, just in a damn kind of way. The Dow falls 57 points. That's from an all-time high, 42,454. The NASDAQ falls just 9 points, 18,282. And the S&P falls just 11 points, and that's from an all-time high, 5,780. So guess what? Stock's down, but the market's certainly not panicking over this data today, at least like I did, because I was like, damn, this is a double whammy against the Federal Reserve. Certainly going to throw a wrench in their gears, I think, guys. We'll talk more about that later in the show. So the bond market, well, it was a weird day in the bond market. You see this? So more of the same. You got the 10-year selling off and bond investors buying the 2-year. So the yield rises on the 10-year up 3 basis points today, sitting at 4.10% on the 10-year Treasury. The 2-year actually falls 6 basis points. So buyers buying up 2 years, 3.96 on the 2-year. So I guess they're still counting on rate cuts for the shorter term. But it looks to me like they're not really expecting long-term rates on cars, rates on houses, rates on, stuff that's kind of linked to the 10-year, which is pretty much every kind of debt. Looks like they're kind of discounting the idea that those rates are going to come down a little bit. Looks like we're going to get moving toward a little bit more normal looking of a yield curve. So we're going to keep an eye on that and watch it as well. It's just really interesting that with all of this data we got today, and we'll talk about the data in detail. The markets didn't really freak out at all. The dollar, not much happening with the dollar, down 1 basis point. 102.89 on the index, still a good strong number in the face of everything the dollar's dealing with. So we're happy to see a strong dollar. Precious metals today, gold and silver. Gold rallies up $22.50, a nice rally for gold today. $2,631.20 for an ounce of gold. Silver rallies up 62 cents, $31.10 for an ounce of silver. Happy to see silver moving away from that $30 support number. The consolidation's still on. Go silver. Oil today spikes up. Kind of surprising, but I guess you still got all this crap going on in the Middle East. And I saw some articles. I guess Israel is getting ready to retaliate. Now, who knows what that means, guys? The way these guys are doing it, they're doing this tit for tat back and forth, right? So now it's Israel's turn. Now, what they've been doing, though, is there really hasn't been much escalation in these tit for tat. So it's, okay, we're going to blow this guy up. Okay, we're going to launch some stuff at you, which we know most of it's going to get shot down and did. Okay, been going back and forth with this nonsense. Like this is some new kind of war they're fighting. So now it's Israel's turn, and everybody's worried because now they're concerned that Israel, instead of just doing this they're taking shots at each other, but nothing major. Now they're concerned that Israel might come out and actually do some real damage and escalate the war. So that's got the worries of that, because it didn't happen. Just the worry that it could happen has oil prices spiked up over $5 in the last few days. $75.94 for a barrel of West Texas Intermediate, which is slightly higher than our estimate would be. But I'm telling you right now, guys, if this Israel-Iran thing was not happening, oil would be below $70 a barrel right now and probably still falling. Bitcoin today, not a good day for Bitcoin, guys. Bitcoin falls $1,135 after a big fall yesterday as well. Breaks the support number at 60,000. Last I saw sitting at 59,798. So now we're going to see. Here's the test now for Bitcoin. Is that 60,000 number now, is it support? Where it comes down to 60 and bounces? Or is it resistance now, where it climbs to 60, hits that, and bounces down? So it's going to be fascinating to watch it. I was really hoping that Bitcoin, like silver, was going to kind of consolidate above 60,000, like silver has and is doing above 30. Now we get to start all over again. Now we broke that support. So now it's time to get back above what now would be resistance and start the consolidation again. So not a good day for Bitcoin, guys. CPI day, we knew this was coming, guys, and we had an upside surprise, as most of you know. 2.4% on the top line versus 2.3%, which is what they expected. That's down from 2.5 last month. So the number is actually still down, just not down as much as they were expecting, which put kind of a negative spin on it. Core inflation came in at 3.3% versus the 3.2 they were expecting. That's down from 3.4 last month, so it's actually still down, just not down as much, right? The monthly numbers in both for core and headline in CPI, both came in higher. They were expecting 0.1 for both. They got 0.2 for headline, 0.3 for core, which not good numbers. Now, guys, again, this is exactly what I've been warning about. I'm telling you guys about. You cut rates too soon, or you cut rates too deep, and inflation comes back. It's just that simple. Now, today's numbers aren't very big. It's not a big miss when inflation actually still came down, just not as much, right? But the numbers are still higher than the target and moving in the wrong freaking direction, guys. And we never really have gotten back under 2%, which is their number. Now, what's interesting to me, I talked about this yesterday on the show, and I was saying how weird it is that the core inflation is so much higher than the headline inflation. Usually the opposite is true because the headline number includes energy, gasoline, power, etc., oil, and it includes food, which is spiking still like crazy. So to have top line so much lower than core was really odd. So I did a little bit of research on this today. I wanted to find out what exactly does that mean, right? And here is what I got. It said, if core inflation is higher than headline inflation, it might indicate that temporary drops in food or energy prices are keeping the overall inflation rate lower. So apparently, energy prices are spiking up a little bit, but are down pretty significantly from where they once were. Food prices been kind of sketchy, moving back up again, but have been down for a little bit. So what they're saying here is the volatility stuff is actually keeping the headline rate lower, right? So you take out those, the headline rate would probably be right where core is at 3.3, right? So it says that keeping the overall inflation rate lower, but that there are still underlying price pressures in other parts of the economy, such as housing, healthcare, or services. This could signal persistent inflation that central banks, like the Federal Reserve, may be more concerned about as it reflects more structural inflationary trends. So core higher than headline is obviously not good news, and we need to start paying a little more attention to this core number because I think that really reflects more realistically where inflation is than this PCE bullshit or even the CPI headline number. Bottom line is the Fed still has some work to do on inflation, and cutting rates isn't gonna get it done. Okay. Now this report will give the Fed something to chew on next month, November 7, when they meet for their next open market committee meeting. It'll certainly strengthen the hawkish rate people, the hawkish rate arguments that they want to have a very slow, drawn out pace to rate cuts rather than a more aggressive rate cutting the rate doves want. So it's going to be fascinating this next meeting. Now, I got to say, guys, it's likely that this report today rules out a half-point cut next month. I don't think it's there. It's called for, number one. It's not prudent when you see inflation not where you're going the direction you want it to go. Now the markets, I wrote this down here, rules out a half-point cut, but the argument goes now, should it be a quarter? Rather than a quarter versus a half, it's should we cut a quarter or should we just pause? And a lot of Fed governors also saying, not actually arguing for a pause, just saying they would not be opposed to one, which is interesting already starting to come out about that. Now you're going to have the battle for what are we going to do? Now, the Fed funds markets, which we know we follow the odds on that, and it kind of gives us a little bit of foreshadowing what the markets are thinking. Markets believe an 80% chance of a quarter point cut, November Fed meeting, and a 22%, just over 20% chance of no cut at all. So all of a sudden, the market's now not even really talking about a half-point cut anymore. That happened quick, didn't it, guys? And now the more of the talk, and you're going to see it keep going this way as we get more data in, no cut. And I was talking to you guys, was it yesterday or the day before, about Ed Yardeni, who's a pretty smart analyst, saying that no more cuts this year. Well, reports like this one tend to make me believe he might be right. And I've been a little bit skeptical about all these rate cuts as well, as you guys know. It's not really prudent monetary policy to be cutting rates into a strong economy. It just isn't. And now let's see. It's going to be fascinating to see tomorrow's PPI numbers, because this will give us a little bit of foreshadowing. When you see wholesale costs, if they're spiking up, You can assume retail costs are going to follow suit because none of these people eat these costs themselves. They pass it along. So now that puts a lot more pressure on PPI tomorrow. And means I got to be up super early at 5:30 waiting for that number to come in. But really, really, really interesting stuff. Now the Federal Reserve's job today got a lot harder. That's for sure. Now you also saw when you couple this data with jobless claims, well, jobless claims spiked pretty hard, coming in at 258,000 versus 230,000 expected, the highest number since August of 2023. So largest number in more than a year. Economists kind of trying to gloss this over. Well, Hurricane Helene and the Boeing strike and guys, bottom line is this is the double whammy for the Fed, guys. Double freaking whammy. Because now you got inflation not going where you want it, stubborn, and now after that jobs blowout, now you see layoffs increasing, and now there's a 30,000 increase. It's a lot, you know. So this really gives the Fed a lot to think about, man. If I'm a Fed governor, I'm like, no more cuts. But sadly, I'm not. All right, couple quick hitters. TD Bank today admits to money laundering for Chinese cartels and agrees to pay a $3 billion freaking dollar fine. Now, in my experience, guys, most of these corporate criminals, when they pay a fine like this, when they agree to pay $3 billion, typically that means that they made more than $3 billion doing this scam. So the government going to let them keep a little bit of the profit, probably give them the opportunity to write the $3 billion off as well. Just astonishing to me, the first U.S. major bank that is admitted to money laundering. Crazy. Homeowners are tapping equity. It looks like at the fastest pace since 2008. Home equity loans going through the roof. 23.6 billion freaking dollars in just the last couple months. So there's the big store of cash a lot of consumers have is in their home equity. Now they're starting to tap that home equity to do things with the money, to have the money. Rates are in the 8s on home equity if you're thinking about that. A lot of people don't want to give up their first mortgage at 3 or whatever. So they're, rather than refinancing and taking cash out on a first mortgage, they're taking these home equity lines and taking cash out of their houses that way. And that's on the rise bigly. Exxon, this was an interesting story today. Exxon is developing a 271,000 acre CO2 carbon storage site in the Gulf of Mexico, guys. 271,000 acres. What they plan to do is capture this CO2 and bury it under the Gulf of Mexico. Now, I'm not sure if they're actually going to try and put storage tanks down there. They're just going to put it into the ground under the Gulf, or exactly how they're going to do it. But they're talking about this being the next $1 trillion industry as more and more people are clamoring for help with this climate stuff. And we're seeing how bad it's getting. If taking CO2 out of the atmosphere can help us with this, even the smallest amount, I think we should do it. So Exxon, the big oil and gas companies, now working hard on providing solutions, which I say bully for them. If they can make money and solve our problem at the same time, good for them. They deserve every penny they get. And lastly, guys, Social Security announced today a 2.5% raise for Social Security recipients next year. That's down from 3.2%. I think it's a good number. I think Social Security recipients will hate it because they're going to say they already don't make enough to keep up with prices, and this is not going to help them. So we'll see. But anyway, guys, that's it for the day. We'll wrap everything up tomorrow with PPI and all. I think we're going to get consumer spending and a whole bunch more data. So we'll have a big day tomorrow. I appreciate everybody being here. Oh, JP on today. Nice. Good to see everybody in the chat. The chat going nicely. Tomorrow's another day. Got a little NFL tonight. Got the Yankees. So a good evening to relax. Back tomorrow at my desk going crazy. I'll be here to bring you guys the news you need, everybody. Oh, P.S. Hit the thumbs up, hit that like button on your way out. It really helps the show, guys. See everybody tomorrow. Until then, take care, everybody.